So there's a question I want to ask before we get into today's video. What does it mean to use the same dollar twice? It sounds like it shouldn't be possible. Money is either in one place or it's in another place. You either spend it or you save it. You invest it or you keep it liquid. But there is a category of financial strategies that does allow capital to perform two functions simultaneously. It's called collateralized lending. And when it's structured against the cash value of a participating whole life insurance policy, it produces some of the most efficient capital strategies that's available to an incorporated Canadian business owner. In our book, The Wealth Multiplier, we call this stacking investments. Now, I'm not going to oversell it. Leverage strategies have real risk. They're not for everyone. They require careful structuring and they need ongoing monitoring. But for the right business owner in the right situation with the right plan, they are genuinely powerful. And it's worth understanding properly before you decide whether to do it or not. My name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial, and I'm going to walk you through what this actually looks like. Now, here's the core idea. This is called collateralized lending against cash value life insurance. And let's start with the mechanics because the strategy is more elegant once you understand exactly what's happening. Inside a properly funded participating whole life insurance policy, the cash value accumulates over time. That cash value represents a real contractual asset that's backed by the financial strength of one of the major Canadian insurance companies. It's a stable, low volatility asset that grows on a tax-deferred basis through dividends and through guaranteed accumulation over time. And here is the key insight. The cash value is also extremely attractive collateral to a lender. So most Canadian banks and the insurance companies themselves will lend against the cash value of a participating whole life policy, usually at favorable rates. And we're talking like prime, prime minus, prime plus a little bit, depending on the lender, depending on your situation, depending on the type of loan. So the basic mechanics of how this works is like this. You don't withdraw the cash value, you don't surrender the cash value, you don't disturb the compounding inside the policy, it keeps compounding for your entire life. Instead, you take your policy to a lender, like a bank or the insurance company, and say, I'd like to borrow some money and I'm going to give you my policy's cash value as collateral. The lender approves the loan based on the cash value as security. You receive the money and then you can now go deploy that however you want. You invest it, you use it for a business opportunity, you fund your retirement income, you buy real estate. Your clients are doing all sorts of stuff with this. Meanwhile, the cash value in your policy is continuing to grow as if nothing happened because nothing has happened, right? The cash value hasn't been touched. It's still sitting in the policy. It's still earning the dividends. It's still compounding. The bank just has a collateral interest in this policy. And so this is what people mean when they say, $1, 2 jobs or stacking investments, right? This is what we write about in our book, The Wealth Multiplier. There's a whole chapter called Stacking Investments to describe this piece of the concept. So the job number one is the cash value is doing what it's supposed to do. It's growing inside the insurance policy, which is a tax-sheltered structure, and it's sitting on your balance sheet in probably your holding company. Job number two, the loaned money, the money that the bank gave you that's secured by the cash value, you go and invest that somewhere else doing something productive, back into your business, buying a portfolio, buying real estate, whatever you're doing, right? So this economic spread is really what makes the strategy work, right? Because you're growing the money inside the policy and then you're borrowing the money and then you're investing it again over here. So you're growing it in two different places and you're paying this loan interest somewhere in the middle. And then if you do it right, these numbers should work out, right? You should be getting a return inside the insurance policy and you should be getting a return, hopefully, inside the thing that you invested in. So that is the engine. Now we're going to look at 3 of the most common ways that this engine actually gets used, right? This is real world stuff from clients of ours. First one is what's called an immediate financing arrangement. This is for the owners who want the insurance benefits plus the liquidity of the cash value at the same time, starting right away when you set it up. Now, how does this work? So you set up this participating whole life insurance policy inside your corporation, probably your holding company. You're funding it with retained earnings and ideally significant capital. And in order for it to qualify for an immediate financing arrangement, it should be like a few $100,000 per year into the policy as a minimum. You don't want all of that capital to be locked up while this policy builds. You want to use the money for something else, for somewhere else, right? So at the same time that the policy is being set up, we also talk to the bank and arrange a line of credit against the policy, right? It's secured by the policy cash value. Now, each time you make a premium payment, so every year, the bank will lend you back some amount against the new collateral. And again, depending on your situation, banks are lending anywhere from like 70 to 100% of the cash value. Depends on your situation, but generally you're safe with those kind of numbers. The result is you're effectively running the insurance strategy without having all of this money sit outside of your business or outside of your investment portfolio, right? The premium you use to fund the policy, then you get a bank loan immediately that makes you get money back in your hands. And then you use that for whatever. It could be the corporation operation. It could be business growth. It could be buying another business. It could be investing in the market, real estate, other investments, whatever. Now, why does somebody do this? Because now these premium dollars are doing two things at the same time. Well, actually three things. One, you get the insurance that you need. Then inside the policy, they're building this tax-deferred cash value, generating the CDA credits when you pass away. And they're providing all the structural advantages that we talk about in the many, many videos about the immediate financing arrangement on our channel. Outside of the policy, your loaned money is funding whatever the other investment is, your business, your portfolio, whatever. Ideally, this is producing some sort of return for you. You're not losing the money or you're not just blowing the money. So the IFA concept makes sense for an owner who has strong cash flow and an active need to be able to use the money, and they want to maximize the strategic value of every dollar that they're using. Definitely not for everyone, because this adds complexity. It requires ongoing monitoring of the loan, and there is real interest rate risk here, right? But for the right profile, the right person, it is one of the most efficient capital structures that's available to an incorporated Canadian business owner. The second one is what's called an insured retirement plan, or an IRP. So this is for somebody, a business owner who doesn't need the money right now, but wants to use the policy to generate really tax-efficient income sometime in the future, usually around retirement, which is why it's called an insured retirement plan. And here is how this IRP works. You fund the policy normally during the years that you're earning and accumulating. You're not borrowing against it right away during this period, but you could if you needed to. And then you're letting this cash value compound undisturbed for 10 years, 15 years, 20 years, 25 years, whatever it is. Minimum 10 to do this properly. But by the time you reach your retirement age, the policy's accumulated some sort of significant cash value, could be hundreds of thousands or millions of dollars, depending on how you funded it. Now you're going to reach a retirement age. So instead of drawing, or in addition to drawing income from your RRSPs or other accounts, those accounts are taxable when you take the money out, or instead of withdrawing from an investment portfolio, which might involve some sort of capital gains, or you had like a bond portfolio, it's got a bunch of interest income. Instead, you take your policy, you take it to the bank, and you get a loan against the policy cash value. Those loan proceeds are not taxable, they're loans, they're not income. And then you use those loan proceeds to fund your retirement lifestyle because you've got income coming in from multiple sources. So the policy continues to grow inside the corporation, and then the interest on the loan accumulates against this loan balance, right? When you set it up as an IRP, the bank doesn't ask for interest payments. What happens is eventually, when you pass away, the death benefit of the insurance pays off the loan plus any interest, and then whatever's left can flow to your beneficiaries or to your shareholder beneficiaries through the capital dividend account, totally tax-free. So the strategic advantage here is that you generated retirement income from the accumulated wealth without triggering the massive tax consequence that comes with traditional investment or traditional retirement income sources. There's definitely real considerations with this approach. The loan-to-value ratio on the policy needs to be monitored, usually on an annual basis. The interest rates in the environment affect how this strategy performs over time. So you've got interest rate risk. And then the math really depends on how you structure the policy. And it does need to be structured a certain way to be correct from the beginning. And you need to be setting these things up probably 10 years as a minimum before you want to actually use it for retirement income, because you need to give it time to grow. Now, if you're an owner that has a long enough planning horizon and a long enough attention span, this IRP is one of the most tax-efficient retirement strategies that's available in the Canadian system. Now, the third kind of structure is just investment leverage, right? This is the one that tends to interest like real estate investors or other types of investors and owners who are actively building investment portfolios outside of the core business, outside of your operating business, right? And the mechanics on this is super straightforward. You borrow against the cash value of your policy, and then you use that money to invest. So typically in some sort of income producing, a lot of people do real estate, or they'll do like an investment portfolio, like a non-registered investment portfolio, corporate investment portfolio. The reason is this is structurally interesting is beyond just the leverage, right? When you borrow money, when the loaned capital is used to generate investment income, the interest on the loan, under the right circumstances, can be tax deductible. Now, we'll talk about this a little bit in greater detail in the next section, because this is where the rules are really specific and the documentation on all of this matters. And this is where you need a good accountant, because your accountant will handle all of this. Assuming that your deductibility rules are properly satisfied, you end up with a strategy that looks kind of like this, right? You've got the cash value inside the policy, compounding tax deferred forever. Then you borrow the money, and then your loaned capital is generating some sort of investment return on whatever you've bought. Then the interest on this loan can be deductible against the investment income because you're borrowing to invest. If you're doing this for real estate, you may also benefit from depreciation or from leverage on the property itself and long-term appreciation of whatever the real estate is that you bought. This is a strategy that puts your money to work in multiple ways simultaneously. So when the spread on this is positive and the structure is properly documented with your accountant, this could be super efficient and can really accelerate your wealth growth. When you do it sloppily and you don't have good documentation and you're not stress testing against interest rates changing and you don't have a realistic loan-to-value monitoring, this can be remarkably destructive and can put you in a super bad position. These three types of ways of doing it, these three structures cover most of the practical use cases. This is what our clients do. There's variations, there's combinations, but if you understand the basics of the IFA gets the money right away, the IRP gets the money sometime later, or the borrowing to invest, doing it now, this is the toolkit, right? Then the next question is, when does the interest become deductibility? And what do you actually need to do to support that deduction, right? And again, this is for your accountant. I'm not an accountant. This is not tax advice. This is just words that you can use when you talk to your accountant so that you get the right advice. The way that the interest deductibility works and the CRA reality check, we're going to spend some real time on this section because it is where the strategy gets oversold, I think, by people who don't fully understand the rules or people who are trying to be too aggressive. And so we want to start with a clear caveat. I am not your tax lawyer. I am not your accountant. I am not giving you legal or tax advice for your specific situation. This is just a video on the internet. The general principles I'm about to walk through are accurate, but how do they apply to your particular situation really requires professional advice from someone who is reviewing your specific facts, your accountant, your tax lawyer, your financial advisor. Now, that's out of the way. The basic framework, right? The CRA's general rule on interest deductibility is pretty straightforward as a concept, but way more complicated in actual application. So in Canada, interest on borrowed money is deductible when the borrowed money is used for the purpose of earning income from a business or property. So that's the test. The use of the funds, like what you're doing with the money, determines on if you can deduct the interest. If you borrow against the policy and you use the money for personal expenses, like a vacation or a car, or you bought a new Rolex, that is not deductible. This is personal use of borrowed funds, totally non-deductible. If you borrow against the policy and you use the funds to invest in some sort of income-producing thing like a property, rental real estate, you bought dividend-paying investments, you bought a business, the interest can be deductible because the funds are being used for the purpose of earning income. Sounds simple, but the complication is from how do you track this and how do you document it? The CRA expects you to be able to demonstrate the use of the borrowed money. So this is called a direct use test. And the connection between the loan and the income-producing investment needs to be very clear and needs to be traceable and documentable. Like, I took $1,000 and I bought this thing for $1,000. You can very clearly see this. The best practices involves, maybe you're maintaining separate accounts for the borrowed funds. You very, very certainly should be keeping clean records to trace the borrowed money from the lender to whatever you bought, and then being able to articulate this income earning purpose at the time that the loan is taken, right? Like, I'm going to buy this thing with this borrowed money. If you do this and you get sloppy, where the loan funds are getting commingled with personal funds, or the use of capital is unclear, or the documentation is maybe not that great or doesn't exist at all, this is where you get deduction problems if the CRA reviews the situation. And the CRA right now is auditing like crazy, so I would make sure that your documentation is correct. I would make sure you talk to your accountant about that. The other complication is that the rules around the interest deductibility have really specific provisions for life insurance policy loans. So the treatment really depends on whether you're using a direct loan from the insurance company versus a collateral loan from the bank and using the policy as security. There's nuance around the adjusted cost basis, around the capital dividend account credit, around how the loan is structured. So depending where you get the money from a life insurance policy also affects this. And this is where you got to be really direct, right? If you're considering one of these strategies, especially the leveraged investment strategy where the deductibility is part of your economic case, you need a properly structured engagement with your accountant and ideally with a tax professional who specializes in this area. This isn't a formality. This is like something that you definitely should do. Because if the deductibility falls apart because your documentation isn't good, or because there wasn't like a clear use of funds, or, then the entire economic case changes. Like, the strategy still works hopefully for you without the deductibility. You still have this dollar working in two places. So the mechanics of this thing is still operating, but now your spread between the policy growth and whatever you're paying interest on the loan changes. The after-tax math changes. And it could be meaningful, because if you were expecting to deduct and now you can't, makes a difference. So the practical advice is, don't pursue this strategy just based on enthusiasm or napkin math, right? And don't do this depending on the deductibility if you're not also prepared to prove that you're doing this the right way. You want to do one of these strategies based on a properly structured engagement. You have the right professionals, you have the right documentation to support any of the deductions from day one, and where the economic case is stress tested with and without the deduction working for you. This is the responsible and conservative way to do that. There are risks, and this is the part that you don't see as much online. And we'll talk about that, right? What happens and what goes wrong. Because the version of these strategies that gets promoted online and in some sales presentations focuses heavily on the upside. What gets discussed less honestly is the risk profile that happens when these structures are in a difficult market environment or when interest rates go against you. And we want to walk through these real risks that need to be understood before you implement one of these strategies. So risk number one, interest rate exposure. The economic case for these strategies depends on the spread between the cost of the loan and the growth inside the policy and the growth in whatever you're investing in when you're using the money. So if prime is 3% and your policy is performing at 5% or 6% on a tax-deferred basis, fine. Spread is comfortable. Strategy is producing meaningful advantage. If the prime rate is 7% and your policy is earning 5 or 6%, the spread inverts, it might not be as attractive this year. It might still be attractive in other years, right? So you really want to look at this. Maybe that's not the year to borrow. Maybe you're going to borrow in a different year. And these aren't theoretical changes, right? Like, we saw this happen a couple of years ago in 2022, 2023, as interest rates started to go up. Some clients had these strategies set up in a low interest rate environment in 2020, 2021, when interest rates were very low. And suddenly now interest rates are going up and they've got significantly higher interest costs each year. Like the strategy doesn't fail, but the math changes, right? It becomes a little less attractive. So if you're implementing a leveraged insurance strategy, you need to be able to model what happens at different interest rate scenarios, including interest rate scenarios that you don't like or that you don't expect. Like run it on the bad ones. If the strategy only works if everything goes right, if the strategy only works if interest rates are super low, it's not a strategy. It's like you're a bet that interest rates are going to stay low forever, right? So probably they're not. A properly structured strategy works regardless of the interest rate environment. Sometimes more efficient, sometimes less efficient, but ideally it's always sustainable. The second risk is your loan to value can drift, right? So when you borrow the money from the bank, they're going to impose some sort of loan to value restriction on the policy, right? So typically you can borrow, like I was saying, right, 75 to 100% of the policy cash value, depending on the lender. But here's what, you might not hear about. If the interest accrues against the loan over time and you're not paying it down, that loan balance is growing. So if the policy's cash value is not growing faster because maybe a low dividend or because you underfunded it for some period of time or because it's a difficult economic environment or whatever, this loan to value ratio can drift. So if the loan to value reaches whatever the bank's threshold is, they could require additional collateral. They might ask you to repay some principal. They might ask you for interest payments. Or if you can't do any of those, they could collapse the policy and take the cash, which they don't want to do. We don't want to do. Nobody wants to do that. But they could force surrender of the policy. That could also have significant tax consequences for you too. So that is the scenario that nobody wants. And it doesn't really get discussed in the promotional brochure, but it is real and it happens to people who maybe are too aggressive or don't structure their leverage correctly or don't properly document. So the way to manage this is being very conservative when you're structuring things up front. Don't borrow the maximum allowed. Leave some headroom so that your loan to value ratio can move and you've got some room. Monitor your numbers every year or every quarter. Monitor your loan, monitor the interest, monitor the policy growth, and make sure that everything still works. The third risk is leverage, especially leverage against a soft market. So this is the one that could surprise people the most. So imagine that you have borrowed the money and you've invested in real estate or an investment portfolio. So the leverage amplifies your returns on the way up. Fantastic. If the market goes the other way and softens, real estate values come down, your investment portfolio drops 15, 20, 30%. The loan against the policy hasn't changed. The cash value of the policy has continued to grow, but the assets you bought with the borrowed money have dropped. Now you have a problem, right? The underlying investment could be worth less than the loan that you used to buy it in the first place. So if the policy can absorb this issue because the loan is secured by the policy and not by the investment, you could have some years to ride this out. But if your overall financial picture requires some sort of deleveraging, you may be forced to sell some investments at a loss while still owing the loan against the policy. So like I was saying, the leverage amplifies the returns on the way up, but it also amplifies on the way down. Right? This isn't a clever observation, right? It's just basic math. It's, people who are implementing these strategies during good markets sometimes forget that the same mechanics that are helping you on the way up is going to hurt on the way down, right? And the way to manage this is realistic stress testing, not just optimistic projections. What does this strategy look like 30% below where things are today? What does it look like 50% below what it is today? Could you sustain the leverage in a multi-year downturn, right? If the answer is no, well, you're over-leveraged. A properly structured leverage strategy should be designed to survive bad markets, not just thrive in a good market. Anyone who's setting up one of these policies should be modeling worst-case scenarios as carefully as they're modeling best-case scenarios. And that's really the responsible way to have this conversation. So what does a good leverage structure look like? Right? Given everything that I've just laid out about the risks, let's describe what the properly structured leverage strategy looks like. Because I'm not trying to scare anyone away from this. It's generally a powerful tool when implemented with the right discipline. I just want to be clear about what is the right discipline. A well-structured leverage strategy will have a few different characteristics. So number one, it must be based on a fully funded, well-designed underlying policy. The leverage works because the policy works. If the policy was poorly structured to begin with, maybe you underfunded it, the base premium was too high, it didn't design to have a lot of EDO or cash accumulation. The leverage strategy on top doesn't fix the problems, it actually probably compounds the problems. So the foundation needs to be right before you start building on top of it. And this is where you definitely need to work with the right type of advisor who's going to build the policy correctly for you in the first place. Secondly, the leverage needs to be conservative relative to the collateral. So a disciplined strategy will operate below your maximum loan to value that the lender is going to allow. So this creates a buffer for the interest rates to change, buffer for the market to change, buffer for slower than expected policy performance, right? The ones who get in trouble are usually the ones who max the leverage from day one and leave no margin for things to go wrong. Thirdly, the strategy needs to be stress tested against multiple scenarios, not just the base case, right? What happens with higher interest rates? What happens in a market correction? What happens if the dividend scale goes down? What happens if the cash flow in a certain business year is down and you can't put the premiums in? The strategy that will survive is the one where the owner walked through different scenarios with their advisor before setting it up, not after problems emerge and you need to fix. You want to fix before the problem. Fourthly, the strategy has a documented use of funds and clean tracing for deductibility, right? So this protects your economic case if ever the CRA reviews, and you want to ensure that the after-tax math that the strategy was sold on actually holds up under scrutiny. Fifth, strategy is monitored on an ongoing basis. It's not a set it and forget it. Relationship between the loan, the policy, the broader financial picture, you need to review this regularly, like minimum annually, sometimes more often when the conditions warrant, especially if you've got bigger loans. When all of these 5 things are in place, that leverage strategy becomes what it's supposed to be. It's a structural advantage that will compound for decades. If even 1 or 2 of these things isn't set up right or is missing, the strategy becomes fragile quickly in ways that won't show up until something changes or potentially goes wrong. So this is the difference between leverage as a tool and leverage as a gamble. It's not the leverage that is dangerous. It's how you do the leverage. It's how you implement it. It's how you have discipline around it. Now let me bring this all together. Leveraging against a participating whole life insurance policy is one of the most powerful tools that's available to an incorporated Canadian business owner. When you structure it well, it lets you put the same dollar to work in multiple places at the same time. It can generate retirement income with significant tax efficiency, and it can amplify your overall financial outcome in ways that are really hard to do with anything else. But the same mechanics that make leverage so powerful also make it risky when it's structured carelessly or sloppily. You have interest rate exposure, you have loan-to-value drift, you have the asymmetric risk of a leverage meeting a soft market. So these are real things that you need to consider. These are not theories. These are real things that happen and put people underwater. The version of this strategy that works, it's what we recommend to clients and what we want to implement. It's conservative in the initial structure. We stress test against different scenarios, especially bad scenarios. We document for taxes, or we don't, your accountant does, and we monitor ongoing with the bank, with the insurance company, with you, with your corporation, with your accountant. So the version that doesn't work is the one that is too aggressive and maximizes everything from day one, assumes good conditions forever, skips the stress testing because the optimistic scenario looked so fantastic. Both versions exist in the market, and we've actually had to clean up some bad situations that other people have set up. But the difference here is how you implement and how you have discipline around it over the long term. If you already have a participating whole life policy somewhere and you've been wondering about how to actually use the money that's been accumulated inside of it, These strategies are worth understanding properly. If you don't already have one and you want to talk to somebody, this is what we do, and we're happy to chat. Whether they're the right fit for you and whether the strategy is the right fit for you depends on your specific situation, depends on your specific risk tolerance, depends on your specific time horizon, and how does your overall financial picture work here. Now, if you're incorporated, you own a business, or you're a real estate investor and you've heard about immediate financing arrangements or IFAs or an insured retirement plan or leveraging and life insurance policy, and you've been trying to separate the substance from the marketing, this is the conversation that we want to have with you at Safe Pacific, right? We don't sell these things as a one-size-fits-all solution. We don't oversell the upside, and we don't skip past the downside or the risk. We want to sit down, we want to look at your specific situation, we want to model different scenarios and tell you honestly whether one of these strategies could fit your situation. And how does it need to be structured if it is going to fit your situation? The way we do this is, number one, you go to our website and book a discovery consultation. So the website is safepacific.com. There are lots of buttons on the site where you can book directly into one of our advisors' calendars. You can also go on contact page, and from there you send a message. It'll come to one of us on the team, and we will reply to you within 24 hours to set up a time. We are very transparent about what works and what doesn't. If one of these strategies is right for you, we will let you know. And if one of these strategies is not right for you, we will also let you know. It doesn't benefit us to work with clients that are not a good fit. That is just purely asking for headaches that nobody wants. Our job isn't to sell you on any of these strategies. Our job is really to find out your situation and see if this thing fits. And if it does fit, how do we set it up in the best way? Now, if you got some value from this is a very niche video, not a lot of people that it probably applies to. So please help this get out into the world to more people that are successful business owners like you that have retained earnings inside the corporation. The way to do that is you click the share button, you click the like button. If you have any questions, leave a comment below. Make sure you subscribe to the channel because we put out these videos every single week. And feel free to go through the rest of the channel and watch any one of the hundreds of other videos that we have on these types of strategies. That's it for me today. My name is Laurent Munier from Safe Pacific Financial. Thanks for watching, and I'll see you next time.